Okay, so you want to own a boutique fitness franchise. Not a whole gym from scratch, not the headache of building your own brand, your own class formats, your own marketing from zero. You want to buy into something that already works, a name people already trust, a workout format that's already trendy, a system somebody else spent years perfecting. So all you have to do is sign the paperwork, find a storefront, and open the doors. That's the entire pitch of franchising. And on the surface, it sounds like the safer version of owning a gym. Someone else already took the risk of figuring out the concept. You're just executing it. Walk past one of these studios on a Tuesday evening. Heart rate monitors glowing on the wall. A trainer yelling encouragement over a speaker system. A lobby full of people in matching branded gear checking in on an app. It looks like a machine that already works. And all you did was buy a copy of it. Here's the problem: you didn't actually buy a fitness business. You bought a very specific financial relationship. One where a company far away gets paid a percentage of your revenue every single month, regardless of whether you personally make a single dollar of profit. A boutique fitness franchise is not a gym you own. It is a royalty agreement that happens to come with treadmills attached. And understanding the difference between those two things is the entire story of why this industry has produced some of the most spectacular financial collapses in franchising, even while individual locations kept their parking lots full the entire time. Let's start with what you're actually buying. Because like every business in this series, boutique fitness franchise isn't one thing, it's a spectrum. At the budget end, brands built around the low-cost, high-volume model let you buy into a system charging members $10 to $30 a month, banking on massive membership counts to cover a lean operation. In the middle, 24-hour access brands sell a stripped-down, low-staff model, a keycard entry system, and a room full of equipment. Minimal payroll, minimal class programming. At the top of the market sits the category this video is really about: the boutique brand, high-intensity interval training studios, cycling studios, Barry Studios, the kind of place that charges $25 to $40 for a single 45-minute class and sells itself on community and intensity rather than square footage. These boutique brands are where the franchise fee structure gets the most aggressive, and where the gap between what the franchisor promises and what the franchisee actually experiences has become the widest in the entire fitness industry. Let's use the numbers from one of the most recognizable names in this category, because unlike a lot of what we cover in this series, this one is a publicly traded company that had to disclose its actual financials to federal regulators, which means we don't have to guess. The total investment required to open a studio in this category typically runs from around $349,000 on the low end to nearly $786,000 on the high end. Once you count construction, equipment, initial inventory, and working capital to survive the opening months. That range includes a flat franchise fee of $60,000 paid up front, just for the right to use the brand name and operating system, before you've built out a single square foot of studio space. After you're open, the ongoing fees kick in. A royalty of 7% of your gross monthly sales, or $2,500 a month, whichever number is higher, plus an additional brand marketing fund contribution on top of that. So far, this sounds a lot like the franchise structures we've seen elsewhere. A flat fee up front, a percentage of revenue on an ongoing basis, standard stuff. Here's the part of that sentence that matters more than anything else in this entire video. And it's easy to read right past it. That 7% royalty is calculated on your gross sales, know your profit, not what's left over after you've paid rent, paid your trainers, paid your utility bills, and paid down the loan you took out to cover that $458,000 average build-out cost gross sales. The top line number before a single expense has been subtracted. According to the most recent disclosure documents these franchises are legally required to file, the median annual gross sales across several hundred established studios came in at roughly $407,000, with the average landing slightly higher, around $454,000. That means a typical studio owner is writing a royalty check of somewhere around $28,000 to $32,000 a year to the franchisor, calculated purely off revenue coming in the door, completely independent of whether that studio is actually turning a profit after rent, staffing, equipment financing, and marketing are paid. Think about what that means structurally. If franchisors' revenue is safe the moment a class gets booked, Your revenue, the money you actually get to keep, is whatever's left over after every other bill in the building has been paid, in whatever order your landlord, your staff, and your equipment lender happen to come calling. One of these two parties in this relationship is taking on operational risk, the other one is collecting a fixed percentage off the top no matter what happens downstream. This is the single most important structural fact about franchised fitness. And it's the reason the corporate side of this industry can look robust and growing even while individual studio owners are quietly drowning. Now let's talk about what the studio owner is actually working with once that royalty check clears. Industry disclosures put the average payback period for a studio in this category at around 6.2 years, meaning it typically takes more than 6 years of operation before an owner has recouped their initial investment, assuming nothing goes wrong along the way. And plenty goes wrong along the way. Remember, gross revenue of $400,000 to $450,000 a year has to cover rent on a commercial storefront, typically a minimum of $1,000 to $2,000 a month even in a modest market and considerably more in a dense urban location. A roster of certified trainers who need to be paid whether the 6 a.m. class has 4 people in it or 40. Ongoing equipment maintenance and replacement. Insurance, utilities, software and booking platform fees, and the royalty and brand fund payments we just walked through. After all of that, industry benchmarks for this category put realistic owner earnings somewhere in the $60,000 to $75,000 range in a solid year, on an initial investment that can approach $750,000. That's not a disaster, but it's a meaningfully thinner margin than the glossy Discovery Day presentation tends to lead with. And it explains why the resale market for these studios tells its own quiet story. Existing studios that do trade hands often sell for a fraction of what the original owner put in. Going concerns changing hands for figures well under $200,000, against original investments that frequently exceeded $400,000. Now here's where this stops being a story about thin margins and becomes a story about what happens when the entire structure gets stress tested at scale. Because one of the largest brands in this category gave us a real-time, fully public demonstration of exactly that in July of 2021. This company went public on the New York Stock Exchange at $16 a share, backed by a wave of celebrity investment that included Mark Wahlberg as both an early investor and the company's chief brand officer, valuing the entire franchise system at roughly $1.4 billion. The growth story fueling that valuation was built almost entirely on one number. Franchise unit count. The company had told investors it expected to open around 1,000 new studios that year alone, each one representing a fresh $60,000 franchise fee and a new stream of monthly royalty payments. A year later, in July of 2022, the company issued a strategic update that unraveled almost the entire premise. Full-year revenue guidance was slashed nearly in half, from a range of $255 to $275 million down to just $120 to $130 million. The company disclosed it would open roughly 60% fewer new studios than it had promised only 2 months earlier. A $250 million credit line the business had been counting on evaporated entirely. Roughly 110 corporate employees were laid off, and the company's founder and CEO resigned the same day. The stock, which had already drifted down from its $16 IPO price, fell more than 60% in a single trading session and kept falling from there, eventually trading for less than $1 a share by the following spring. The company was delisted from the New York Stock Exchange in August of 2023, roughly 2 years after its celebrated debut. A wave of securities class action lawsuits followed, ultimately resulting in a settlement north of $10 million paid out to investors who'd bought in near the top. And buried inside the disclosures that came out during that unraveling was the detail that mattered most for anyone thinking about buying one of these franchises specifically. Of the roughly 700 new franchise agreements the company had reported selling in the first quarter of that year alone, more than 300 were later terminated, and hundreds more were revealed to be conditional agreements that had never actually been backed by real financing in the first place. The growth number investors had been valuing the company on had been substantially inflated by deals that were never going to become real, functioning studios paying real royalties at all. Here's what's genuinely strange about this story. And it's the second layer of the reversal that makes this business so different from a business that simply fails. The corporate entity nearly collapsed, its stock became essentially worthless. Its founder resigned, and it eventually accepted a buyout offer at $4 a share. a fraction of its IPO price. And yet, through almost all of that turmoil, individual studios in strong locations with engaged local ownership kept running classes, kept collecting monthly membership payments, and kept, in many cases, paying their royalty checks on schedule. The corporate story and the local studio story are not the same story, even though they're wearing the same brand name on the door. A franchisor's stock price reflects investor expectations about unit growth, new franchise sales, and total system-wide revenue. A single studio's health reflects whether the trainers show up, whether the 6 a.m. class stays full, and whether the owner priced their memberships correctly for their specific zip code. You can own a genuinely profitable individual location inside a franchise system whose parent company is simultaneously getting delisted from the stock exchange. And plenty of owners did exactly that throughout this entire saga. But you can also be the owner holding a signed franchise agreement, a half-built studio, and a $60,000 franchise fee already paid. At the exact moment the corporate financing that was supposed to help you open evaporates. Which is precisely what happened to hundreds of the operators caught inside those terminated agreements. The lesson sitting underneath all of this is that when you buy a franchise, you are making two separate bets at once, whether you realize it or not. A bet on your own ability to run a profitable local business, and a bet on the financial stability of a corporate parent you have almost no visibility into and even less control over. And those two bets can go in completely opposite directions at the exact same time. Which raises an obvious question, one worth sitting with for a moment before we get to the final numbers. If the royalty structure is stacked this heavily in the franchisor's favor, and if a brand's public collapse can leave hundreds of operators holding a franchise fee and a half-finished lease with no financing behind it, why do people keep lining up to buy in, year after year, brand after brand, even in categories that have already produced a very public train wreck? Part of the answer is that the entry point genuinely lowers the psychological barrier to starting a business, compared to building a concept from nothing. A first-time owner with no background in fitness programming, no existing brand recognition, and no proven class format can walk into a discovery day, review a set of financial projections prepared by people who do this for a living, and walk out feeling like they've de-risked the hardest parts of entrepreneurship, the parts about knowing what actually works. That feeling isn't entirely wrong. The workout format usually does work, members usually do show up for a well-run class. The operational playbook usually is more sophisticated than what a first-time independent gym owner could build from scratch. What it doesn't do is transfer the financial risk of a market downturn, a bad lease negotiation, a competitor opening nearby, or a corporate parent overextending itself away from the person who signed the franchise agreement. Part of the answer is also that these systems are specifically built to be financeable, structured to qualify for SPA-backed small business loans, which lets an owner open a nearly $500,000 studio while putting down a fraction of that in actual cash, financing the rest through debt that has to be serviced whether the studio hits its projections or not. That financeability is presented as an advantage, and in one sense it's what makes ownership accessible to people who couldn't otherwise afford it. But it also means the downside scenario isn't just a disappointing year of thin margins. It's a disappointing year of thin margins stacked on top of a fixed monthly loan payment that doesn't care how the 6 a.m. class attendance is trending. And part of the answer, honestly, is the same story that shows up throughout this entire industry, the visible. Full parking lot on a Tuesday evening tells a passerby nothing about the balance sheet sitting behind it, whether that balance sheet belongs to an independent gym owner, or a franchisee 3 years into a royalty agreement with a company that's since been delisted from the stock exchange. Let's build one real, complete scenario and walk through what a genuine first few years actually looks like for someone who buys into this category today. Say you invest $458,000, the reported average, to open a single studio in a solid suburban market. Your first full year of operation, still building your member base, generates $320,000 in gross revenue below the system median because new studios typically take 18 to 24 months to ramp toward full local awareness. Your royalty and brand fund payments on that revenue run around $25,000 for the year. Rent, staffing, insurance, and utilities for a studio this size typically run somewhere between $220,000 and $260,000 annually. In the optimistic scenario, you've hired strong trainers, your class schedule fills reliably, and by year 2 your gross revenue climbs to the system average of around $454,000. Your fixed costs grow only modestly as a share of revenue, and you land in that $60,000 to $75,000 owner earnings range the industry benchmarks point to, putting you on pace to fully recover your initial investment inside that roughly 6-year window. In the realistic scenario, a competing boutique studio opens 2 miles away in your second year, pulling away price-sensitive members right as your own membership growth was supposed to be accelerating. A key trainer leaves and takes a portion of the client relationships with them, and your gross revenue instead plateaus around $370,000 for the year, while your fixed costs have already grown to match the larger studio you built. Under those conditions, your owner earnings for that year can shrink to somewhere close to break-even, or even a modest loss, while your 6-figure build-out loan payment and your royalty obligation to the franchisor keep arriving exactly on schedule regardless. The difference between those two outcomes has almost nothing to do with whether the workout format is popular, whether the brand is trendy, or whether people in your neighborhood want to get in shape. They clearly do. That demand was never really the question in this category. It comes down to local execution, local competition, and whether the corporate parent backing your brand stays financially healthy enough to keep supporting the system you paid to join. 3 variables that are only partially within your control, sitting underneath a royalty structure that was carefully designed to keep getting paid regardless of how any single one of them turns out. So if you do decide to buy into a boutique fitness franchise, remember the one thing that actually determines whether it works out. It was never really about whether you picked a brand people love right now. It's about whether you understood, going in, that you were the one absorbing the risk in that relationship, while the name on the door was collecting its percentage either way.